review your liquidity needs. And this is for both an emergency fund and an opportunity fund. Usually when we look at liquidity needs, it's just for worst case scenario, just for emergency funds. But that emergency fund can also be an opportunity fund. And so I like to look at those in both ways, emergency and opportunity, because a lot of times an opportunity creates a cash flow emergency. You're listening to the M-Advisor podcast. I'm Paul Morton. M-Advisor helps physicians with their financial planning. This podcast is intended to provoke insight into your finances so you can learn, plan, and create a legacy you're proud of. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research, Inc., a broker-dealer, member FINRA SIPC. Advisory services offered through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and M-Advisor are not affiliated. You're listening to the M-Advisor podcast. I'm Paul Morton. The M-Advisor podcast comes out on payday, the 15th and 30th of each month. Today, we're talking about what to do in a down market, and more specifically for savers. And I'll classify a saver as somebody who's not yet retired. Although a lot of these concepts can be implemented in any stage. So from a financial planning standpoint, not an investing standpoint, maybe the next episode we can discuss an investing standpoint of what to do in a down market. This is from a financial planning. So we are looking at a bigger picture. We are looking at the future in all of our assets and financial decisions, and not just our investments. When there's a down market, or really when there's any sort of, let's call it threat or opportunity in our financial lives, the first thing that we need to do is take a look at our budget. We need to make sure that we've managed our budget appropriately so that our overhead and our living expenses, they're not going to interfere either when we are capitalizing on an opportunity or when we are dealing with an actual threat. And managing our budget, that might just mean knowing what we're spending or knowing how little we could spend if things get real tight. So then I like to have two overhead figures or two budgeting figures. A real month, and that's really what we're spending on a normal month. So we might be going out to eat at restaurants. We might be spending money on traveling or niceties and luxuries. And that's a comfortable month to us. And that's really what our budget is. But I also like to have a secondary budget number or a secondary monthly overhead number. And I call this a basic month. So if I had to, let's say, like live in residency again, if we scaled back all of those luxuries, all of the niceties, of course, in a basic month, we're not traveling. We're not doing much extra. We are keeping it pretty simple. What is the smallest amount per month that our budget could shrink? So managing that and knowing those figures are important. Because if we had to revert to that quote unquote basic month, then we know what that figure is. And then number two, review your liquidity needs. And this is for both an emergency fund and an opportunity fund. Usually when we look at liquidity needs, it's just for worst case scenario, just for emergency funds. But that emergency fund can also be an opportunity fund. And so I like to look at those in both ways, emergency and opportunity, because a lot of times an opportunity creates a cash flow emergency. And so we want to identify if we have too much cash or not enough cash or just the right amount. And so we want to really connect this with our budget, because it might be a multiple of a real month, or it might be a multiple of a basic month that we need to keep in liquidity reserve. I would say number 2A or even number 3 would just be to understand and review your insurance policies. When the market goes down, we have oftentimes lower valued assets. If we were to die during that time, then we're passing on potentially a lower amount of assets to our spouses, our kids, whoever our beneficiaries might be. And so we just need to make sure that that gap of what our assets were and what our assets are in current value doesn't interfere with legacy goals or needs. So when the market goes down, the whole idea from a financial planning standpoint is to make sure that your current positions, the current things that you've instilled in your plan from a risk management or from a protection standpoint, still adhere to your needs in that arena. And an example of how our risk management needs might change is we might have bought a life insurance policy in residency, and we made $50,000 at that point, and the life insurance policy we bought was plenty for that amount of income. But we really haven't changed our insurance amounts since then, and we've had maybe some great financial success in our endeavors after residency and fellowship. And so our income is way higher than it was when we originally bought the policy, and we haven't reviewed or we haven't looked at that insurance policy in a long time. Or even our cash reserves. A lot of times we will go to work and come home and repeat and don't manage cash reserves. And sometimes those cash reserves can actually build up. And if we're sitting on too much cash, that's great when an opportunity like a down market might show up. But it can also put our financial plan in an incredibly inefficient position. And so from a financial planning standpoint, market goes down, review the things you've done. Review the basics on cash flow and budgeting, liquidity needs, both for emergency and opportunity, and make sure that any kind of down market doesn't put your legacy goals in a tough spot. Thank you for listening. I'm Paul Morton with M-Advisor. M-Advisor helps physicians with their financial planning. You can visit m-advisor.com for more information. You're listening to the M-Advisor podcast.